Good afternoon, everyone. And I know this is the last session, which can always be a challenge. We'll try to keep it crisp and to the point. And the topic for this panel is private equity scenario. Infrastructure, as we know, is a vital driver of economic growth in both developed and emerging markets. Notably, huge investments in infrastructure, for example, the Reliance Digital Fiber Infrastructure Trust investment of over $1 billion, have provided momentum to overall PEVC investments in India. And annual private equity investments in India is expected to surpass $65 billion in 2025. But statistically, though 2019 saw PE investments at large, 2020 witnessed a relative decline in these investments. This was mainly on account of underperformance of the infrastructure sector, which attracted the highest PE investment in 2019. Even 2021 continued to show a material decline in PEVC investments in the infrastructure asset class. The reason for the same includes the crisis in the non-banking financial sector, the financial challenges faced by infrastructure companies, and the inadequate developed Indian market for infrastructure financing. However, despite macroeconomic headwinds and the pandemic, the infrastructure sector continues to present attractive opportunities and robust demand. For instance, India has a requirement of investment worth almost 50 trillion rupees, which is roughly $777 billion across infrastructure by 2022 for sustainable development in the country. Further, there is strong policy making, and we have seen the setting up of the NIIF and the NBFID and other initiatives like House for All, Smart Cities, missions which enjoy government budget allocation of over 1.89 billion. However, all has not been rosy for private equity journey of India. In 2014-15, around US $500 million of PE investment was estimated to be stuck in legal disputes. While 86 private equities invested in $2.9 billion in highway by 2025, there were only exits worth $25 million. Similarly, it was estimated that out of the total investment of US $16 billion in India infra by 2013-2014, only about $4 billion saw an exit by 2015. By 2020, we started seeing innovative models for exit, and PE started looking at exits from strategies such as mergers or SPAC or even blank check companies. It is in this background we are joined by industry experts to discuss India's infrastructure's private equity scenario. We have with us today Kunal Agarwal, Principal I Squared Capital. I Squared is an independent global infrastructure investment manager focusing on energy, utilities, telecom, transport in the Americas, Europe, and Asia. Pratibha Jain, she is the General Counsel and Head of Corporate Affairs, Everstone Capital. Everstone Group is a leading private equity and real estate investment firm focused on supporting the growth aspirations of entrepreneurs, corporations, and asset owners across India and Southeast Asia. Montek Mayal, Senior Managing Director and Practice Leader, India, Economic Consulting, FTI. Montek has consistently been ranked as the leading valuation expert in India, and he focuses on assessment of quantum, finance, economics, and valuation in both contentious and non-contentious matters. Shiva Ramakrishnan, Vice President, Investment, GIP, a leading global investor in infrastructure fund manager, currently managing 75 billion in assets. With this, I would like to straight move on with the panel. And the first question I have, Shiva Ramakrishnan, is for you. What is the current stance of private equity investors on India infrastructure? Is it a yay or a nay?
Hi Pratik, thanks thanks for the question, and thanks for inviting me on the panel. Glad to be here. On your question, current stance of private equity investors, I wish it was a simple yeah or nay question, but if it had to be boiled down to a single yes or no, it will always be yeah. It's based on India's economy, which has had a strong economic recovery, much better than expected after COVID. And like you mentioned in your opening remarks, there are so many sectors where there is such a long runway for growth. We have, be it renewables, where you have say 450 gigawatt target. If it's roads, you take 40 kilometers a year target. In telecom, you have data explosion, 5G coming up. So there are a lot of excitement in this space, and it's always been a good place to invest in.
Thanks so much. And Kunal, would you agree with this?
Yeah, thanks, Prateek, and good afternoon to all the participants and the attendees. So I kind of second what Shiva said, and I think, and I mentioned it in my previous discussions also, that investing in infrastructure, whether it's in India or any other country, requires a much longer term mindset and patient capital. And whenever you use that lens, there might be blips like COVID, there might be other temporary hiccups, but the fundamental of what India has to offer is the consumption-led growth, the growth in the middle class and all of that. I think none of those factors have fundamentally changed, which means as an extension that we as infrastructure investors continue to place India very highly on our radar and continue to be quite bullish on what India has to offer. So that will be point number one. And I think point number two, what we're also seeing in India is a very continued favorable policy environment, whether it is a better understanding on the entrepreneurial community to welcome institutional capital like ours, being more open to selling assets, selling control, banks taking a more active role there. And then on the policy side, more and more sectors are opening up to welcome institutional long-term capital. Government is come up with increasingly innovative ideas such as the national monetization pipeline, which some details were released a few days back. On the policy front also, InvIT continues to develop as a product. There's talk of now a development financial institution. So all of these, in a nutshell, means that as any global infrastructure investor, India is a market which you cannot ignore, and continues to present a lot of opportunities.
Thank you, Kunal. And I think the takeaway are two key words, right? Innovation and control. And I think that leads to my question to Pratibha, who has been on the forefront of innovation. She was part of the NIIF, and of course, with Everstone infrastructure part of it, doing a lot more investments, sitting on the driver's seat. There is a lot of control, I presume, in those assets now. Pratibha, what's your take on the infrastructure sector? Do you think these two elements play a key role, or are there other elements in the current stance?
So Prateek, I'm actually very pleased to hear Kunal and Sivaramakrishnan being so positive on Indian investments, especially private equity investments into Indian infrastructure. You dial back to 2011 to 2014 when India was struggling and trying to figure out how to get investors to invest in equity in infrastructure. And at that time, everybody was talking about the bond market and how, it's either PPP or the bond market that is the answer to India's woes, because we just were not attracting enough investments. And, you fast forward today, and there's so much liquidity and so many infrastructure focused funds in the market. I Squared, I don't think even existed at that time. The fact that you've got such an interest, I think definitely, 2015 NIIF was created exactly for that purpose. And to clarify, I wasn't in NIIF, I helped set up NIIF. while I was still in private practice. But it really, I think the government putting its weight behind putting equity investments into the sector gave it the fillip, and then you had specialized funds like I Squared, you had patient capital with ADIA and the Canadian pension funds coming in. Pretty much all of them are here in big um, cut big ticket sizes for Indian infrastructure sector. I think all of that has really helped to be at this stage where we are saying, yeah, it's a definite positive year, and I really hope the next cycle, because we've got patient capital, we are able to give the returns to investors, so that private equity is a cycle, right? You've got to give exits for the money to come back. So right now we are still at the investing stage with all these investors, with some of the key exits, right? For example, GIP exiting its road assets to KKR. So we've seen some big ones, but I think the real test will be when we see this cycle of investing move towards exits, and we are still able to do the next round of investing.
On that note, Pratibha, exits were difficult primarily. Of course, there were several reasons, but one primary reason was the control on the asset was pretty weak. And what we hear, at least today, the strategy seems to be moving where the private equity itself is taking more than 50% and sitting on the driver's seat. Do you see that? Do you see that change in investment strategy?
Oh, absolutely. I think, if you talk about pretty much all the big private equity, or the sovereign or the pension funds, they all are doing either bilateral control deals, or you see them setting up platforms and creating their own team to then either create the operating assets and or acquire the assets. So whether it's CPPIB, CDPQ, I Squared, Everstone, GIC, everybody has NIF itself. They're all looking at platforms, and that has, as you said, solved at least the promoter issue, as we used to call it in those days, where you're not dependent on the promoters delivering the results to you. You create your own management or replace the management, so at least you have better control on those issues. I think what remains as an issue, Pratik, which was already mentioned slightly, is the policy front, right? The policy vagaries, we can't, unless we take over the government, we can't do anything about that. But the push on, I think at least at the central level, like Kunal mentioned, the policies are the government is quite focused on the infrastructure sector. That's why you see the InvIT changes coming as and when the sector requires it, or the national infrastructure pipeline, or the monetizations that were announced. So at the center, you see them working with the investors. I've even seen, tenders being changed to accommodate investors, which are in the nature of not promoters and private equity funds, which are set up as trusts or which have a diversified holding. All of that accommodation we've seen from the central government. I think the problem still remains, and these are democracy issues, right? The center state issues still remain. So when you're investing at a state level, or when you have tenders with municipalities, I think those issues we need to figure out a solution for.
Right. So when you say the problems with the state governments, I presume it is performance of a signed contract or payment of monies due in time. Those would be the biggest hassles as you start moving down the chain.
Absolutely, your policy changes. We had one situation where I had one private equity fund call me and say, we won a tender, and then somebody told the chief minister they can get a better price. So they canceled the tender, and The tender was won by a private equity fund, leading one at that. So they were threatening to cancel it. So we had to escalate it to the center level, and the center state government was the same, thankfully. But there are issues like that, where the sensitivities to when an institutional investor comes into the picture, and one government does something like that, it creates because we have global ICs and global investors to answer to. So one black mark in a country can really stop you from doing the next round of investments.
No, that's absolutely key, and we will hear today from Montec in what his experience has been in these areas of non-compliance and tender. But I will give a point from my own that this is one of the largest problems, at least we see in the industry, which is performance by the government. And at the end of the day, I think it's the private equities who need to exercise their rights as foreign investor to discipline the government. We've seen some sort of discipline come in the tax regime when foreign investors use their rights to discipline the government. And I think it is this nature of it's this form of diplomacy, I would say, with the government, which is necessary to discipline them, because I think the systems are such that they've been scot-free for the misbehavior, and I think that old hangover needs to go pretty quickly for markets to get more confident. But let's leave the larger pictures of issue away, and let's come to the near-term issues, and especially the 8 to 12 months where we've seen the COVID-19 pandemic. Nothing like that was expected. I'm sure no one's valuations and projections in 2019 really accounted for it. If anyone's did today, I would be very happy to hear that your fund did predict it. But if it didn't, it of course definitely impacted the way you predicted the cycle of revenues and the cycle of profits. What's the overall experience is what I would like to know. And Shiva Ramakrishnan, it's for you. What's your experience in these 12 months? Has it been very hectic?
Yeah, see, the past 12 months have actually shown us that risk is what is left after you thought you have covered everything else. So in all your ICs, you cover market risk and regulatory risk and credit and operations, technology. Nobody covers what happens if a pandemic can happen. But having said that, once the pandemic hits, it brings forth the importance of portfolio management at any fund. And private equity is not just about doing mega deals and then moving on to the next one. It's also about sustaining your existing investments, nurturing them, ensuring that in such times of crisis they respond well. And to just add to what Pratibha had mentioned, the days of private equity investors taking minority stakes and then just depending on the promoter to resolve all crises, those days are gone, right? It's no longer just sitting at the board and asking a few questions and then moving on. Now PE investors are in control. We have to get down on the ground, get our hands dirty, and ensure that issues are resolved. The last 12 months have been more focused on portfolio, more focused on ensuring liquidity is maintained at each portfolio company. You don't get into any kind of stress at any level. Being transparent with the banks and lenders and taking them into confidence that what are we doing to ensure that this event doesn't derail their support. And all of this has been a big learning experience. The good thing is that even sectors which are initially badly impacted, for example, say roads, when the first lockdown happened, toll collection was completely suspended, and lockdown anyway impacted the movement of people. But even those sectors have kind of recovered very rapidly as soon as the lockdowns opened up, even though we had a second wave, even though we might have a third wave. They have been very resilient. And of course, other sectors like renewables or say, telecom, they have not had any issues in terms of collection revenue. There have been one-off instances, but overall it has been a very positive experience. And contrary to expectation on the deal flow side, while data doesn't show up, there has been enough and more capital coming in across a multitude of sectors. Despite COVID, people have found ways to do deals and uh, announce deals and get capital tied up.
Right. And Kunal, would you like to add something to this?
I think Shivaramakrishnan has brought up all the key points in my mind as well. I think I'll just emphasize maybe on a few. I think this the importance of having a diversified portfolio has never been more important than now, because of course even within the infrastructure spectrum, some sectors have been badly hit and continue to have a, let's say, a relatively benign outlook going forward, such as airports. uh, some sectors were impacted but have recovered very quickly. I think the classic case would be roads. And then there are sectors which have actually benefited from COVID or had tailwinds from COVID, like basically the digital infrastructure sector. So having a diversified portfolio, I think, has been really an advantage and a lesson. I think, of course, this whole 8, 10, 12-month experience has also taught valuable lessons on portfolio management, people management, and then having very robust systems and technology backbone in place, such that, in these times when everybody is working from home, in a sector like infrastructure, not everything can be run from home. So how do you strike that balance? How do you ensure continuity of services and adherence to concessions, while at the same time, looking at the people toll of it, has again been a good overall kind of key experience in the last few months. I think in terms of deal flow, I agree with Shriram Krishnan. It's the numbers may tell whatever story they tell, but I think it's been as active a period as ever. There has been, one way to mention this is with certain sectors being more distant than others, it also leads to more transactions coming to the market. And then, anyways, the gestation period of a life cycle of an infrastructure trade is a little bit longer than let's say a few weeks and months. So we continue to see a lot of deal momentum. In many cases, it's also translating into a little bit more structured trades where you may want to kind of structure the risk around continued impact of COVID, which is anybody's guess on whether there will be a third wave, and when do we truly recover and return to normalcy. So I think that's the other experience, if I can use that word, over the last 12 to 18 months. But again, I'll just end it with one more thought, which I mentioned earlier, that a lot of it comes down to the thing that you have to take a long-term view. When we make an investment in any sector, we're not looking at 1 or 2 years of performance. We're looking at a much longer time period, and I think that general feeling is still there, that these sectors will revert back to those original trajectory sooner rather than later.
Thanks, Kunal, for those comments. And there is one important point I took from what you said, and you said that it's time to look at newer segments and newer sectors like digital infrastructure. What are such new sectors you would say that would come in now with the pandemic in picture?
Yeah, so I think so maybe starting off with that, digital infrastructure is one. So we're already seeing plenty of activity on that space, from whether it's on fiber, whether it's on towers. I think the one sector which within this, let's say, space is data centers. So that, I think, is also becoming a key beneficiary of this day and age, and also driven by regulatory kind of tailwinds on data localizations and data privacy and so on and so forth. So I think digital infrastructure would be one. I think the other sector, which is very topical, and not only in India but generally getting more and more prominent in any infrastructure manager's radar, is generally on resilient investing, whether it's on clean tech, like things like EV, the next generation of renewables, like including batteries, etc. Other even more traditional investments which you do. How do you reduce the carbon footprint? How do you achieve a little bit more sustainable, inclusive investments, and keep in mind the climate impact of what you're investing? I think that theme is gaining ground quite rapidly. Other than that, look, it's also not driven by the opportunity set. So the most amount of activity continues to be, at least from my perspective, in those usual sectors like roads and renewables um, and the likes. But there's a lot of investment opportunity coming from the government stable. Like there's divestments of public companies. There's the national monetization pipeline, which I mentioned earlier. There's newer sectors which are opening up, like railways and railway stations. So I think those are also very interesting and things which we are looking out for to develop and mature into in the times to come.
That's very interesting. And Shiva Ramakrishnan, do you have other segments or the same segments, would you agree, are the newer sectors to look at?
Yeah, largely very similar, I would say, to what Kunal has mentioned. See, the one broad theme, like you mentioned, is this decarbonization and greening, which gives rise to a host of opportunities across renewables, in renewables also. I think slowly the flavor will change over time, from selling to utilities to gradually moving to private PPAs and providing power as a solution through battery hybrid, where you tackle large CNI customers, etc. There's been a lot of activity in the CNI space, I guess, in the last 2-3 months. Uh, uh, a part of this decarbonization theme is also how gas will become a transition fuel from your coal to ultimate renewables, which is, I guess, city gas has been a fairly active sector. I think iSquared did something or announced something recently around that. The other theme is obviously this data explosion, which is happening. The amount of data that Indians consume is, I guess, among the highest in the world on a per capita basis. It's a rare change from everywhere you see investment bankers coming and pitching, whether it is power consumption or uh, roads per kilometer. Everywhere per capita, India will be fairly low compared to advanced countries. But telecom is that rare exception where Indians consume like 15 GB of data per month, and not many countries are consuming that. So that is going to be a very interesting play, and that's a sector where a lot more can happen, right? 5G can come in, and once 5G comes in, more and more interconnected devices, those, how will they communicate? I mean, as it is within infra, we are feeling like dinosaurs, because this is a generation where people are trading cryptocurrency and investing in NFTs, and the world is moving at a much faster pace. Uh, I think the last part that I would like to add is what COVID has thrown up is within the transport and logistics part, there is a clear difference between transporting people versus transporting freight. And the freight part of it has shown to be fairly resilient, be it cargo handling, be it ports, where and even for roads, the traffic that was sustained immediately after the lockdowns opened up was largely commercial traffic. So these three are the newer things. One smaller bucket of opportunity, which hopefully over time will grow, is around the what Pratibha also happened to mention, is the dealing with urban local bodies and solving their problems around water waste management. Currently, it's not yet become fully bankable, so to say, or not fully in the realm of institutional capital investing. But I guess a lot of opportunities will take up there, as the government is fairly focused on those sectors. And as to just to add to what Kunal mentioned as to where the opportunities are arising from, other than the government and monetization program, A couple of things that are clearly playing out is in many sectors there is this consolidation play. There are, as in the market is quite fragmented currently, but there is a case for the market to get consolidated with 4 or 5 large players. The ability to write large checks will become critical. And like you said, there are other stressed promoters who over time will have to monetize their assets to deliver, because a lot of groups have taken huge leverage. Currently, the banks are pressurizing them to sell off either their core assets itself, but definitely their non-core assets. And there is a lot of opportunity to pick them up. So those would be my thoughts on the newer sectors.
Thank you so much. And if I may summarize, it feels the old sectors will continue to grow, and there will be investments in railways, and there will be investments in roadways. But the data is the new oil, crypto is the new currency, and infrastructure will be digital. I think that's the takeaway of where we are looking in the future. Pratibha, considering this, considering the past and the present, what are the preferred routes being considered for acquiring infrastructure assets?
So I think if I give our own example, right? We've created our own data center fund. It's our latest fund in the market. Um, we still believe not just control but absolute control for assets that require the kind of capital and labor intensive. We are still not looking at local partners. We are still looking at doing it totally ourselves with financial partners from offshore. So I think from what I am seeing in the market, I think we are the first data center fund. But on the other assets, so for example, we have a waste management platform. I think I Squared also has a waste management platform, and it's a process that we see being implemented by funds across in terms of acquiring the professional teams that are required and then training them and getting them the foreign capital to build it. I think in that you will also see increasing secondary deals as some of the big players are still coming into the market. So I keep hearing about, all the Canadian pension funds that are still here, are already here, or the sovereign wealth funds that are already here from Middle East. To that, there are new ones that we keep hearing that are trying to enter the market, and every time they enter the market, we see a big bilateral trade happening. So I think from where we sit, it's management buyouts, it's platforms, it's bilaterals with existing private equity funds. And we also launched a credit fund, which is similar to the trend that you see in the market, where I think a decade after we first started thinking about how to develop the bond market in India, it's still continuing, but I think for private equity funds, the NCD route is still quite viable through FPIs. So a combination of debt and equity in that sense sometimes work. It varies from sector to sector and deal to deal. But to the extent that you still want to take some promoter risk, you look at an NCD structure, I would think, rather than an equity structure. So my bet in terms of how the infrastructure market grows, just given the nature of the assets, you will see not just control, but more buyouts and more platforms being set up and more bilaterals being done among the funds. lot of times when we are looking at bilateral trades, the comfort that the fund that's buying out is that it was already in a professional management hands. So especially with the pension funds, that's that fact pattern is really helpful. So yeah, I think that's sorry, that's where I see the market developing.
If I may just add one thing, Pratibha, I think the other flavor of the season is the InvIT structure for this asset class. I think earlier, the idea was you achieve scale through these platforms and then you can list as an InvIT, which both gives a more efficient, let's say, structure, a capital structure at the same time. It's also a liquidity vehicle. I think increasingly so, we're also seeing this as becoming an entry point as well, where straight away the acquisitions are being done directly through an InvIT route. Like I think in the opening monologue, there was a example given of the fiber trust and probably the tower trust. So I think that's also becoming a very increasingly popular route for acquiring infrastructure asset, I'll say.
I'm glad you brought that up, Kunal, because I have mixed views on a lot of the InvITs that we are seeing happen in the market, not REITs, but InvITs are private InvITs. And then the government seems to have adopted the public InvIT route for monetization of their assets, which I mean, I would love to hear your views on, how successful they're going to be. I just don't see an Indian market really developing retail interest in these assets, but maybe that'll change. But private InvITs to me are just another version of bilateral trades. It's just structuring.
Agreed. I think we bring up a good point, but just as many of these sectors are just not meant or not appreciated by the Indian retail investor, which are more used to the capital gains rather than the dividend stream. So that part I fully agree. But regardless, I still feel that some of the benefits of a private InvIT also lend it for serious consideration compared to, let's say, the usual investment structure. I think on the question, or not on the point which you mentioned about the government public InvIT route. So I frankly have very mixed feelings on that, because in a way it's also crowding out private capital. And then I think one of the objectives of some of this is to also get in more world-class kind of management standards and operational KPIs, which is not achieved by just doing kind of monetization per se through this public InvIT route. So
Yes.
it only achieves part of the outcome. It does get some money back to the exchequer, but it doesn't really solve the issue of also providing better infrastructure, in my opinion, to the Indian public, which is, of course, the underlying objective, that to sustain the growth, and we not only need more infrastructure, but we need better infrastructure.
Absolutely, totally agree.
Right. I'm going to move to the next segment, and I think what we've heard and what we've seen is, of course, there is change in the 10 years, right? The conversation itself has changed. We were discussing issues behind, what should be the rate of return and whether there is pricing guidelines which apply and how much promoter control. And today the conversation has shifted to a much more sophisticated conversation of how do we run the company and how do we take control and make it reach a place where we can exit, and how the government, of course, can help this. So my question to you, Pratibha, is, of course, have things changed for better really? Can we today reach a conclusion that things have changed for better? And what are the challenges still being faced, maybe from a hangover from the past or new challenges which are coming? But what are the challenges currently being faced by private equity? Two-part question to you.
I guess it's such a broad asset class that if you can take each of the subsectors as a class in itself in terms of issues, and they vary, right? Depending on, so for example, a railway is just not really lending itself, except for maybe privatization of the stations and those bids. ev- Even there, it's limited private equity investment going in there. So, other than renewable energy, other forms of energy just don't lend themselves right now to a private equity space. I think the sector that's done really well in terms of, whether it's government interventions or just the market developing for private equity investments is roads. In renewables, I I hope Montek will talk about it in more detail, but we've seen issues in terms of the tender prices being met by the governments, projects being cancelled when the government changes. So the government slash regulatory risk remains. The land intensive projects, which we do a lot through our logistic funds and now through our data center fund, the classic hangover, like you asked question, classic issues still remain in terms of land acquisitions and delays in getting approvals and clearances, etc. But I think it's lend well for somebody like us who understands India well to then manage it. But I would say, if those issues can get resolved, then it will help to a certain extent getting more capital in these sectors. So I think the issues vary. You'll see even the NCLT process, right, Pratik? You haven't seen that many private equity funds succeed in getting assets through that process compared to the strategic local Indian investors. And we can do a whole another session on why the NCLT process is difficult for private equity investors. But I mean, for example, we were able to get the ILFS waste management business through an NCLT process, but it's really one of the rare processes where we were able to get in. So I think overall things have definitely improved. I honestly, just having seen the sector from close in Delhi, honestly believe NIF being in the fray does help. I know probably Kunal will also say, and I think it's true, that to a certain extent they are also crowding out the private investors. But because the government has suddenly become investor themselves, I think it helps in resolving, some of the regulatory issues that we would have otherwise have faced. But still a lot remains to be done. So, for example, airport, right? Mumbai airport issue, even though NIF was involved in the bid, again, airports is somewhere where there's interest, but I really haven't seen private equity investment do that well. So yeah, I think overall, definitely, if you ask me from a decade ago, it's amazing where we have reached, and it's amazing the number of global funds that are investing in India. But given the need that India has, trillions of dollars are required to build the Indian infrastructure sector. I think government intervention at center and state level and recognizing the specific needs that private equity investors have, and then creating policies to fit that, which some have and some haven't. I think that is key.
No, that's absolutely what we've heard from different kinds of investors today. I think that the views which the private equity investors share are the same views which the lenders share and the others. The government is the key player in infrastructure, and the government needs to ensure that its state-owned enterprises and quasi-state entities perform the contract and keep their promises. And I think if that improves, we overall see a much rise in confidence. But Montec, of course, you've been part of infrastructure and private equity disputes for over a decade, and I guess you must have done at least a dozen of them in the 10 years, or a couple of dozen. And you've seen this segment from all sides. What are the biggest challenges you see when you represent a private equity? What are the kinds of disputes, both sovereign, non-sovereign? Could you share your experience with the group?
Yes, thank you. I hope I'm audible, Prateek. Can you hear me clearly?
Yes, loud and clear.
Perfect. Thank you, and it's really a pleasure to be here and hear everyone's remarks. I always say this, but I do mean it. When you go last, your job is much easier because all the good points have been brought out quite well. And hearing everyone today has indeed been quite a pleasure. So I'll try not to repeat things, but try to sort of give some context from more of a financial and economics angle on the key issues that we have seen and the kind of disputes that results in, and what our experience of those has been. But before that, I think there was an issue which I thought quite interesting that was raised in a previous conversation, which was around you're good at funds are good at investors are good at looking at normal risk, but they're not very good at thinking about risks which happen not happen routinely, right? And these are often called black swan events. And I thought it was quite interesting. Someone mentioned that. And I think our experience is quite similar, that firms and businesses and investors are not really equipped, or haven't been historically equipped to analyze and incorporate such risks. But I think COVID is a great example of how they should be considered more properly. And essentially, these end up being low probability, high impact events. And for the reasons I think we've been discussing today, they're even more important for infrastructure sector, which entail large investments. So I thought this flag that I thought was quite interesting. Someone brought that out. But just starting at the top, when you think of the infrastructure space, and as Pratibha mentioned, it's a catch-all phrase in some ways, right? It's an all-encompassing word. It's huge. It talks about, it includes energy, it includes telecoms, includes all forms of commodities. So it's a very diverse sector. And you can't really, at least in my view, at least from a financial perspective, you can't really necessarily generalize all risk. But I thought the three things I think that make the sector quite unique. And as I was listening to everyone, I thought those three things are indeed relevant. The first one is the economics of the sector itself lends itself to higher risk and challenges, right? So it's a very skewed investment profile. In most infrastructure investments, you have substantial high upfront fixed costs and investments, right? Many times either you have low or pass-through variable costs, and your profits and returns are made over the life of an asset, which of course is quite long usually, right? Usually it's 15-20 years plus. So at the outset, you can quickly see there's a mismatch in terms of inflows and outflows, right? Inflows in the form of revenues and profits, and outflows in particular in form of capital expenditure. So that mismatch, creates tension, and unfortunately it's going to remain so for most sectors, right? If you're building, an oil field or a mine, right? Massive expenditure happens up front, and then you extract or dig it out, and then you sell it in the market, right? Same thing happening with fiber networks, right? Massive outlay of capital to build the fiber network, incremental cost of servicing a subscriber is very low, and you make your money over the life of the network. So I think that first of all creates the tensions and the challenges we've been discussing today, at least in some form. The second factor, at least in my view, is usually, and I think Prateek, this was the first line today, is it's vital and critical to the economy, right? It entails valuable resources. Think spectrum, think commodities, right? And it can also result often in natural monopolies. Think railways, think transmission services. So the importance of it creates, again, tension between the various stakeholders that are involved. And then lastly, and it's a function of the first two, I think, in some regard, it's highly regulated. So you have increased regulatory political, and country risk that are often higher than other sectors. I think it's in my view, at least, the combination of those three is what causes whether various challenges, various issues, or the various disputes. Now, when you think about now, let me kind of take this a bit forward. And if you think about these challenges and issues, you can, I think, think about it in essentially two ways, right? One is you can think about these challenges and issues in the context of the actual underlying infrastructure project, right, during its life cycle. And the second one, which also is obviously relevant for today's conversation, is issues and disputes that arise that are relevant to the funds as investors. Now, obviously, there's an overlap because the issues that affect the underlying project will obviously affect the investors as well. But I think you can still define the problem set in these two ways, and they both have their own natural issues. Now, very quickly, and I'm also conscious of time, I think in terms of this first way, in the context of the infrastructure project itself, you can think of, I think, the issues in two buckets again. The ones that arise in the development stage, one that arise in the operational stage. And without going into specifics of each sector, like I said, they have their nuances that affect each sector within infrastructure space differently. I think you can categorize the development stage issues almost in a few forms, right? So you have, I think, and we continue to see this in many of our projects, at least, or where we are involved in, at least on the dispute side, is there delays in land acquisition, registration, and access. I think that remains true for large projects. I think that's just a fact. Now, of course, it's become much better, I think. I think single window clearances, etc., have really helped the sector, but I think that concern remains true, especially in the project is substantial or involves multiple localities and multiple states. That second, I think we still have concerns with regulatory approvals and permits. I think that still can take a lot of time, and especially for mining assets, for example, and that can obviously have a subsequent impact on the sector that uses that commodity. And of course, these delays then obviously naturally result in delays in the project itself. So you end up pushing back the completion of the project substantially, and that in turn causes higher costs because your costs go up, right? When there's a delay. I think on the pure cost side, I still feel, and maybe this is some others might have a view on this on the panel today, but I think most assets and projects are still won under competitive bidding in this space, and I've routinely seen aggressive assumptions in the bidding stage, and that could be in the form of a poor assessment of project cost or timelines. There's usually a bias on the demand side or an overestimation on the demand side. And I think, again, coming back to the risk point, I think the risk assessment is usually not very robust. I think we're good at looking at usual risk, but I think we're quite bad at looking large, low probability risk scenarios. And that becomes really important, I think, from a funds perspective. Again, as point was made earlier, is when you have a diverse portfolio, you want to average out or cancel out those low probability, high risk, right? It's harder to obviously do that on a single project because if it comes in, you really can't prepare yourself. But if you position a portfolio in a particular way, you can perhaps minimize that across the various assets you own. So I think that competitive bidding process, I think, still exposes the projects to quite high risks, which then ultimately come out in the form of either incomplete projects, severely delayed projects, or substantially overrun projects. Second, I think on the cost side alone is variation scope increases, I think, remain quite significant. I think partly it's still to do with boilerplate template agreements we are using. And as we were talking about new sectors emerging, new issues emerging, you have to update those projects, those agreements to reflect a new reality and have a proper mechanism to deal with variation claims, I think, which remain quite substantial in our view on the larger projects. And I think on the cost side, the last thing I would say is on the debt. And the reason I say that is still surprising to see and again, it becomes important in the context I was saying earlier, is the economics of the project are such that you make investments up front and you realize your returns over a number of years. We still find many times the repayment schedule or the bond schedule not consistent with the underlying cash flows. And there's hardly any room for a certain delay in the projects or slightly worse a couple of years because you're running a very, very thin coverage ratio or interest coverage ratio. So I think that again has exposed, I think, many projects to high stress, especially in the COVID time, right? Highly leveraged companies have really suffered the most. And that's quite clear in the stock prices of companies as well. Debt companies with heavy debt were affected the most, I think. And I think that is an important part of infrastructure because of the economics I was defining earlier. I think on the experience side, very quickly, I think there is still often an overestimation or perhaps over-representation of experience for EPC contractors in managing risk, especially associated with long-term triple P concessions. So I think that has caused obviously quite a bit of stress on projects themselves. Usually there's a large-scale exodus of key personnel from EPC companies that affects execution of ongoing projects. And I think last thing, we might be talking about COVID today. I think, look, people have mentioned about investments. There've been a flurry of investments, some very high-profile ones reported in the public media. But I think if you look at year-on-year credit growth, it has been falling, right? It's indicative of the risk aversion of lenders. And I think particularly for below investment grade companies, it's been difficult to refinance. So I think credit growth, I think bank credit growth slowed down from, solid double digits, 13, 14% to, below 5-6% over the last 12 months. I think so. I mean, I know, Pratik, tell me if I'm going way over time, but I just want to very, very quickly talk about from a different perspective. Is just very quickly on the operational side. I think again covered this. Regulatory risk is key, and I think you have to somehow properly model that. But unfortunately, sometimes it's not up to you, but you have mechanisms available to you to seek compensation if they affect the project in a large way. We've seen massive cancellation of PPA agreements. We've seen toll concession agreements being affected because of changes in policy decisions or changes in regulatory framework. Or even because other developments were made in contradiction to the agreement, which didn't allow for such other developments to take away traffic from your project, right? In oil and gas sector, you've routinely seen changes in terms of production agreements or supply agreements, right? Which again can cause substantial disruption to the project economics. Change in all matters, I think, remain quite hot and again hotly disputed. And I think the last factor I would say on the operational side is your pure play economic risk, right? Market conditions. And demand and supply of products. We discussed today that some sectors have benefited or not been that adversely affected by COVID. Telecom could be one, renewable energy because they've given must-run status are another. But again, analyzing the risk properly and managing it, I think more about not just initial estimation of the demand and supply, but how you manage that becomes quite critical, I think, both for the project company and for investors like the funds. Lastly, on the investor side, and I think everybody's mentioned this, and including Pratibha again, which on the evolution of the kind of stakes you're taking up in some of these projects. So I think, unfortunately or fortunately, when you have different types of investments, I'm categorizing investments in sort of just purely two forms, or minority and controlling, right? The types of disputes also change, and the issues you're involved with change, right? I think we've seen a lot of entry-level disputes. We've seen a lot of issues with funds on disputes arising from breach of warranties, misrepresentations, indemnity claims, or breach of investment schedules. I've been involved in 2 or 3 very recently where, especially important in a control stake investments, where you're buying the entire project or the asset or the company that owns the asset. We've seen multiple disputes where the financial position, essentially the performance of the entity being sold, was misrepresented, usually to get a higher price, and that has caused some pain to the funders or the funds, and that often results in an arbitration to seek compensation by virtue of reduction in the purchase price. So I think entry-level disputes still remain hot, and that's partly increased, I think, in terms of crises. And the reason I say that is because in crises, when people don't know how the future might look like, there's often a bias to overestimate the future. So that has resulted in people overpaying for certain assets and then finding out those positions were misrepresented. Exit level disputes, less of a concern for controlling shareholders, but obviously remains quite painful for minority investors. We've seen a bunch of those. Usually the concern here is, again, the price at which the investor will seek an exit. And again, usually the owner of the company, the promoter, wants to pay a lower price, the fund wants a higher price, and that has caused a lot of disputes, I think, including on account of regulations like FEMA, but generally been quite disputed over the last, I would say, at least 5 to 7 years, if not more. And I think, and then the third bucket ends up being everything in the middle. So everything that happens between an exit and the entry, and those are your typical disputes. I think in the infra sector, the only thing a comment I would make here is we've seen a lot of disputes in the related party transaction space, and this is because usually the infra sector, the controlling company, the main company in which the fund is invested in, often uses service of sister and brother companies and other subsidiaries of the ultimate parent, ultimate promoter, and there have been repeatedly concerns around those transactions not being on arm's length transactions. So that's another thing that I think to look out for. It's a risk we should be managing on an ongoing basis, but we've seen a lot of issues arising from from related party transactions. And the other common one is this breach of your usual reserve matters. As everybody would know, investors tend to have quite a few reserve matters where their vote is quite important, and those are often breached, unfortunately, for one reason or the other. And that also has caused a lot of pain, especially I would say breach of anything around investment size. So you obviously have restrictions on what the company can invest in, and that has caused disputes. And the second would be breach of debt covenants and taking on more debt than you should have, and that obviously can have some severe implications during a crisis mode. So sorry, I know I went through a lot of things, but I hope that gives some context to what we've been seeing from a financial perspective, Pradeep.
Pratik, if you're speaking, you might be on mute.
Sorry. Thanks, Pradeep. I was indeed speaking, and I was on mute. So as I said, I think Montague, you very well put it, that there are two buckets: sovereign and non-sovereign disputes. And more often than not, we see when a private equity comes into the India infrastructure sector, they really are looking at both sides of the disputes. In the non-sovereign bucket, they see entry-exit disputes, both at the M&A level, both at the misrepresentation and warranty level, and the exit level, where there is promoter control. But even more so, when there is a control on the asset, you then have to deal with the sovereigns. You have tender cancellations, you have non-performance, you have non-payments, you have corruption issues in the infrastructure sector. There's a whole bunch of issues. Now, in the previous sessions, we had litigation financiers who had come in, and they spoke about how lenders and distressed asset can benefit with their management and finance capability. Now, what comes to my mind is they're pretty much, many of them, styled like a private equity. The business is that, but the asset class which they look at, unlike a private equity, is dispute and litigation. Now, they are the specialists for that. They have their own management team to manage this asset and their capital. Do you think private equities can benefit with litigation finance? Can there be a marriage? And in your experience, how's that marriage work?
So is that to me, Pratik?
Yes, that's for you, Montague.
Okay, thank you. And sorry, very, very briefly before I answer that, the point you made about sovereign risk and tender cancellation, I think that's very, very true. I think the other thing, obviously, you're aware about is how infrastructure assets end up being the most affected and core focus of most investment treaty disputes, where again sovereigns take large actions and increased regulation of assets which comprise the sector. So I think that's another risk that, as foreign investors especially, you are often exposed to for critical infrastructure assets in emerging markets. But I think on your point of litigation finance, I think I understand that, like you said, there was a session this morning, but very, very briefly, I mean, the whole purpose of litigation financing essentially is to fund your disputes, right? And in many ways, whether it's funding your ongoing arbitrations, about to start arbitrations, or your awards once you realize certain awards in your current arbitrations and disputes. I think the couple of important points here, and maybe by way of example, it's best illustrated. So at least my limited experience with the PE funds in the litigation finance arena has been of two folds, right? So one obviously is we're seeing increasingly PE investors, especially where the controlling shareholders, use litigation finance for the portfolio company disputes. And for them, it's great. They understand non-recourse financing, I think, better than most people in this world. And they understand how to isolate risks and really focus on risks that they can manage or they have experience of. So we've seen an increased appetite for companies controlled and owned by PE funds. Look out for financing of this type, where you get non-recourse financing, you share the upside, and you completely move the cost away from your income statement and balance sheets. So that's something I think we've seen picking up quite increasingly, and especially in infrastructure sector, just because those tend to be more expensive, larger, more complex disputes. I think there still remains limited appetite for purely domestic arbitration and disputes. I think that's also changing because they're becoming increasingly comfortable with the credit risk associated with governments and government-owned entities. The second form, which I've also seen in practice, is the investor, i.e. the fund, using litigation financing for itself. And a very recent example, two very recent examples I've come across, is where essentially one of the funds just sold off their investment, their dispute, essentially, once it started. So they were able to raise third-party financing on account of the ongoing dispute. It was a pure play exit dispute, and they used that financing to essentially get money to itself quickly before the dispute had moved on, and of course use the remaining funds to pay for the ongoing costs. And I think the interesting part there was, and I suspect what this was driven by, was to essentially realize higher returns, right? Because again, PE funds recognize time value of money very, very well. They understand, they appreciate money today is definitely worth much more than money tomorrow. So to help their investors, their limited partners, generating a higher IRR could be quite powerful, right? So I think that's the other place we've seen. And the other sort of nuances of at least the second bucket of litigation financing, i.e. where funds use it for themselves in a dispute against a promoter or a company, is there are other circumstances for a fund which are quite unique, right? Often funds have a life. Often they need to realize routine outflows and inflows to demonstrate performance. Often it's opportunistic when the markets are doing well, or they have certain exit options which can be only triggered in a certain period of time. So there are quite a few unique circumstances for at least some of these funds where that this tool can be quite powerful to help finance any exit related disputes. And for them, like I said, keeping the costs away and focusing on things they're good at is quite important. So I think in both forms, and look, I don't want to talk about much about some of the reported transactions. I do appreciate there's some nuances around that. Some have not really gone through, but you are seeing increased appetite for funds to sort of use litigation financing in one form or the other. I mean, the other point I would just make as a side note is also how some of these funds are becoming interested to actually themselves finance some of these disputes, and structured in quite intelligent ways to reduce their risk. And I think this is all really surprising, because for many infrastructure companies today, especially the ones which have been distressed on account of re-leverage, if you think about it, is that they're able to essentially isolate the risk of the claims from the other assets first, and the second is a lot of the value just sits in those claims, and they're quite valuable. And if you get a opportunity to make a 40%, get a 30 or 40% share of the final award, that can be quite powerful and quite high returns you can generate. So I think that's at least the three things that Prateek, that we have seen, and I think at least in my conversations with some of the PE funds, I think they're increasingly exploring using third-party financing for their own disputes as well, or for the disputes of their portfolio companies, and it's just another source of capital for them, right? And they're able to keep the operating capital for your operations and business ventures separate from litigation, and manage the risk accordingly, because one form of capital, i.e. the litigation financing, essentially is non-recourse. So there's very limited downside risk. If the arbitration is fails, or they lose the arbitration. So I think it's another way of managing your overall risks, which, as we've been discussing today in today's panel discussion, remains very, very important.
No, I think you make fair points, Montek, and I would say we've seen this kind of synergy ourselves between private equity and litigation funders, both to diligence the distressed asset on what's recoverable, because generally the focus is on restructuring and revenue. People don't look under the hood. Generally these disputes assets are valued zero and not even considered while betting on it. But at least internally, you need to know whether there is some gold inside the mine. And second is, of course, management. And as you rightly said, PE investors are they're equipped to manage the asset class they are supposed to run. Disputes and recoveries is not one of those assets class. And partnering with another management team who follows the same mindset and raises the capital in the same way could really benefit. But I think one more area we've seen private equities partner with litigations fund is becoming LPs. We do see many private equities now considering an LP strategy into a litigation fund itself, where they have market averse investment, because litigation finance, unlike every other industry, doesn't run on the market. It's pretty much a verse of where the market goes. Once you take a binary decision on the case at the entry point, it's pretty much time value calculation which it follows. And we've seen this kind of investment de-risking portfolios of several private equity investors. So with that,
So Prateek, sorry, just one. Can I just add one point? Sorry.
Yes, go
I think
ahead.
this is quite useful, and of course, if anyone on this panel has a view, that would be very helpful. One interesting thing that happened to us a couple of months now back is also PE fund actually accessing or thinking about accessing litigation financing at the very outset. So we were talking to a fund, a very large one. They were investing, and they realized 30% of the value sits in the claims. And this was before they invested in this project, in this entity which has multiple infrastructure projects in India. And they tried to create a structure upfront where they bought in to the primary holding company, and they tried to move all the claims into an SPV at the very outset of their investment, right? And I thought it was quite interesting, right? And then they could partner up with the litigation funders on that separate portfolio as well, and almost have a clean business, and if I may use the word dirty, and have a dirty business, which is all the claims and disputed assets. So I'll just flag that. I'm not sure if others
No,
on
I
this
think
call have
that's very interesting. In fact, this is the bad bank model, and we are in fact seeing now discussions of can you do the claim SPVs in a SPAC model, and because claims are sitting pretty much large, and if you bring the claim management team where the asset classes claims and they can recover, can you do that at a stage where you can list the entity and take value of it? So we're seeing a lot of crazy things happening. And I think this sooner or later we're going to see recoveries improving with this fresh capital coming in the dispute segment as well. With that, we are at the close of our session. Unless the hosts have some questions from the audience, that is all from our side.
Prateek, there are no questions from the audience. I think it was a pretty insightful discussion and most of the questions were answered. So if you're okay, then we can close